The economics of owning a construction company. You picture towering skyscrapers with your logo hanging from the cranes hundreds of feet above the city skyline. Massive bulldozers carve through mountains of earth. Fleets of excavators, dump trucks, and concrete mixers move like a well-rehearsed orchestra. Every few months, another multi-million-dollar project is completed, another ribbon is cut, and another contract is signed. From the outside, construction looks like one of the most profitable businesses on earth. Governments spend hundreds of billions of dollars every year building highways, airports, bridges, schools, hospitals, and military facilities. Private developers race to build luxury apartments, office towers, shopping malls, warehouses, hotels, factories, and data centers. Every growing city needs builders. Every booming economy creates demand. Every crane on the skyline looks like another money-printing machine. So where's the catch? The reality is that construction isn't simply about building structures. It's about managing risk. A construction company is part engineering firm, part logistics company, part financial institution, part legal office, and part emergency response team. Before a single brick is laid, you've already committed millions of dollars in labor contracts, equipment leases, insurance, permits, engineering studies, fuel, and materials. Unlike software companies, you don't get paid before delivering value. You spend first, sometimes for months, sometimes for years. Only then do you hope the client pays on time. One delayed permit can idle an entire workforce. One steel price spike can erase your profit margin. One lawsuit can consume years of earnings. One rainy season can destroy your project schedule. One subcontractor bankruptcy can halt an entire development. Construction companies rarely fail because people stop needing buildings. They fail because cash flow disappears. The companies that survive aren't always the best builders. They're the best financial managers. Because in construction, concrete builds buildings. Cash flow builds companies. Not all construction companies operate the same way. In fact, the industry contains dozens of specialized business models, each with its own economics. The first category is residential construction. These companies build single-family homes, apartment complexes, condominiums, and housing developments. Projects are generally smaller but more numerous, with faster project cycles and relatively predictable demand. Next comes commercial construction, office towers, hotels, retail centers, restaurants, warehouses, hospitals, universities. These projects often range from several $1 million to hundreds of millions and require far more sophisticated project management. Then there's industrial construction. Factories, oil refineries, chemical plants, power stations, data centers, mining facilities. These projects involve specialized engineering, high safety standards, and complex equipment installations. Infrastructure contractors represent another major category. These companies build highways, bridges, tunnels, airports, rail systems, dams, ports, and water treatment facilities. Most depend heavily on government contracts and public infrastructure spending. Heavy civil contractors specialize in earth-moving, excavation, utilities, and large-scale public works. Mechanical, electrical, and plumbing, or MEP, contractors focus on specialized building systems. General contractors coordinate entire projects while subcontractors perform specialized work such as roofing, electrical installation, drywall, flooring, or HVAC. Large multinational firms often combine all of these services under one corporate structure. Companies like Bechtel, Turner Construction, Fluor, Skanska, and Vinci manage projects worth billions of dollars across multiple continents. Regardless of specialization, every construction company sells the same product. Project execution. Clients aren't buying concrete. They're buying certainty. They're buying the confidence that a building will be completed on time, within budget, and according to specification. Starting a serious construction company requires much more than buying a pickup truck and a few power tools. The barrier to entry rises dramatically as projects become larger. The first investment is your operational headquarters. Small contractors may lease modest office space. Larger firms require engineering offices, equipment yards, fabrication shops, vehicle maintenance facilities, warehouses, and secure storage compounds. Industrial land located near growing metropolitan areas often costs hundreds of thousands, or even millions, of dollars depending on location. Accessibility matters enormously. Being close to highways, suppliers, ports, rail terminals, and labor markets reduces transportation costs and improves operational efficiency. Location becomes a competitive advantage. Next comes licensing. Construction is among the most heavily regulated industries in the world. Depending on jurisdiction, contractors may require general contractor licenses, specialty licenses, environmental permits, bonding qualifications, safety certifications, and professional engineering approvals. Obtaining these credentials can take months or even years. Then comes one of the industry's least understood barriers. Many large projects require performance bonds and payment bonds before work can begin. Surety companies evaluate a contractor's financial strength, experience, cash reserves, and management history before issuing these guarantees. Without bonding, many government and commercial contracts remain inaccessible. Working capital becomes equally important. Winning a $50 million project doesn't mean immediately receiving $50 million. Instead, the contractor often finances payroll, equipment, subcontractors, and materials long before receiving progress payments. Many firms maintain millions of dollars in available credit simply to fund operations between invoices. Equipment acquisition presents another major decision. Should you purchase excavators, cranes, bulldozers, loaders, and concrete pumps? Or lease them? Buying heavy equipment improves long-term asset ownership but requires enormous capex. Leasing preserves cash but increases monthly OPEX. Either strategy requires careful financial modeling. Finally comes relationships. Construction remains one of the world's most relationship-driven industries. Developers, architects, engineers, government agencies, banks, material suppliers, insurance brokers, labor unions, subcontractors. A contractor with strong relationships often wins projects long before competitors even hear about them. By the time the first contract is signed, a medium-sized construction company may already have invested several $million in facilities, licenses, insurance, equipment, software, vehicles, bonding, and working capital. And remarkably, not a single building has been constructed yet. Every industry has capital expenditures. Construction simply has more of them than most. The public sees cranes lifting steel beams hundreds of feet into the air. What they don't see is the balance sheet behind every machine on that job site. Unlike a consulting firm that needs laptops and office space, a construction company must build an industrial ecosystem before it can compete for major contracts. The first major investment is heavy equipment. A medium-sized contractor may own 10-20 excavators, multiple bulldozers, wheel loaders, backhoes, motor graders, asphalt pavers, concrete pumps, tower cranes, mobile cranes, dump trucks, flatbed trailers, service vehicles. A single modern excavator may cost between $250,000 and $600,000. Large bulldozers frequently exceed $1 million. Tower cranes often cost $5 million depending on lifting capacity. Concrete pumps range from $150,000 to over $500,000. Now multiply those numbers across an entire fleet. Suddenly, equipment alone represents tens or even hundreds of millions of dollars in capex. Then comes technology. Modern construction no longer relies on blueprints alone. Companies invest heavily in building information modeling (BIM), GPS machine control, drone surveying, laser scanning, project management software, ERP systems, accounting platforms, fleet telematics, cybersecurity, cloud collaboration systems. These digital tools improve productivity, but require constant upgrades and licensing. Safety infrastructure is equally non-negotiable. Protective barriers, temporary fencing, traffic control, fall protection systems, safety monitoring, environmental controls, emergency medical equipment, worker training. Compliance audits. Every regulation adds another cost. Then comes the hidden infrastructure. Fuel depots, equipment workshops, parts inventories, warehouses, fabrication shops, storage yards, temporary site offices. Portable power generation, temporary internet, mobile communications. Most new owners underestimate these expenses because clients never pay separately for them. They're embedded inside every project bid. One overlooked expense can erase the expected profit before construction even begins. Perhaps the largest hidden capital investment is equipment depreciation. Every hour an excavator operates reduces its future resale value. Every mile driven by a dump truck decreases its remaining useful life. Unlike office furniture, heavy equipment loses value while simultaneously requiring expensive maintenance. A contractor isn't simply managing projects. They're managing one of the largest depreciating asset portfolios in the business world. Winning the project feels like victory. In reality, it's only the beginning. Construction companies don't fail because they lack revenue. They fail because operating expenses consume cash faster than invoices arrive. Payroll represents the largest recurring expense. Project managers, civil engineers, site supervisors, safety officers, equipment operators, carpenters, ironworkers, electricians, plumbers, concrete crews, surveyors, administrative staff, estimators, procurement specialists. A medium-sized contractor may employ 200 to 800 workers across multiple projects. Payroll frequently exceeds $50 million annually. Then comes fuel. Heavy equipment burns astonishing quantities of diesel. Large excavators can consume 15–30 gallons every hour. Bulldozers, generators, concrete pumps, cranes, compressors, transport trucks. Fuel prices alone can dramatically alter project profitability. Maintenance never stops. Hydraulic systems fail, tracks wear out. Engines require rebuilding, tires burst, bearings fail, electrical systems corrode. Downtime becomes extremely expensive because idle machines still generate financing costs. Insurance represents another enormous expense. General liability, workers' compensation, professional liability, builder's risk. Commercial vehicle insurance, equipment coverage, environmental liability, cyber insurance. Large contractors routinely spend millions annually protecting themselves from catastrophic claims. Materials create another financial challenge. Steel, concrete, copper, lumber, glass, asphalt, mechanical systems, electrical components. Material prices fluctuate constantly. A sudden increase in steel prices can erase the profit margin on contracts signed months earlier. Labor shortages compound the problem. When experienced tradespeople become scarce, wages rise rapidly. Projects slow down. Deadlines slip. Penalty clauses activate. Clients become frustrated. Then comes a concept unique to construction: retainage. Many clients deliberately withhold 5% to 10% of every payment until the project is fully completed. Imagine finishing 95% of the work while millions of dollars remain locked inside unpaid invoices. Meanwhile, payroll continues. Suppliers still demand payment. Banks still expect loan repayments. Cash flow, not profitability, becomes the greatest daily challenge. Working capital becomes the company's oxygen. Without it, even profitable contractors collapse. Construction companies often borrow against future invoices simply to finance today's payroll. Finally comes litigation. Construction is among the world's most legally complex industries. Design disputes, contract disagreements, weather delays, safety incidents, defective workmanship, change orders, subcontractor conflicts. A single lawsuit can consume years of management attention while generating hundreds of thousands of dollars in legal fees. The public sees skyscrapers rising. Owners see spreadsheets filled with expenses arriving every single day. Many people assume construction companies simply build projects and collect payment. The reality is considerably more sophisticated. The primary revenue source comes from construction contracts. These generally fall into four categories: one, fixed price regardless of actual costs; high profit potential; high risk, cost-plus contracts. The client reimburses actual costs plus an agreed management fee; lower risk. Lower upside. Revenue depends on measurable quantities such as cubic yards of concrete, tons of asphalt, or miles of pipeline installed. Common in infrastructure projects. Costs above the agreed limit become the contractor's responsibility unless formally approved through change orders. Progress billing drives cash flow. Instead of receiving one payment at project completion, contractors invoice monthly based on completed work. A $100 million project may generate monthly billings between $4 million and $8 million depending on progress. Secondary revenue comes from equipment rental, maintenance contracts, design-build services, engineering consulting, facility management, long-term service agreements, public-private partnerships, infrastructure maintenance. Some contractors also develop real estate themselves, capturing profits from both construction and property appreciation. Margins remain surprisingly thin. Many successful general contractors operate with net profit margins between 3% and 8%. On a $100 million project, earning $5 million may represent an excellent result. This explains why scale matters. Large firms complete dozens of projects simultaneously. Small margins multiplied across billions of dollars in annual revenue become substantial earnings. Investors often focus on another metric. Backlog represents signed contracts not yet completed. A contractor with a $4 billion backlog already possesses years of future revenue before winning another project. For construction companies, backlog functions almost like an order book. Strong backlog provides predictable cash flow, supports financing, and increases company valuation. The industry's greatest asset isn't always equipment. It's the pipeline of future work. Construction has always been a cyclical business. When the economy is booming, cranes dominate city skylines, developers compete for land, governments announce massive infrastructure programs, and contractors struggle to hire enough workers. But when the economy slows, construction is often one of the first industries to feel the pain. Projects are delayed, financing dries up, developers postpone new investments, banks tighten lending standards, governments reduce capital spending. Suddenly, a contractor that was managing 20 active projects may find itself bidding aggressively just to keep crews employed. The danger isn't simply losing work. It's carrying the enormous fixed costs of a construction business while revenue declines. Heavy equipment loan payments don't disappear during a recession. Office leases still require payment. Insurance premiums continue. Fleet maintenance never stops. Experienced employees expect their salaries. A company can burn through millions of dollars in cash while waiting for the next contract. Weather creates another level of uncertainty. A month of heavy rain can halt excavation. Extreme heat can reduce productivity. Snowstorms delay concrete pours. Hurricanes damage partially completed structures. Wildfires force evacuations. Every delay increases labor costs, equipment rental expenses, and overhead while contractual deadlines remain unchanged. Then comes inflation. Construction companies often sign fixed-price contracts months or even years before completion. If steel prices suddenly rise by 30%, or concrete, copper, fuel, and lumber all become more expensive, those additional costs may come directly out of the contractor's profit margin. The client still pays the agreed contract price. The contractor absorbs the difference. Labor shortages can be equally devastating. A lack of skilled electricians, welders, crane operators, or project managers can delay an entire project. Missing a contractual completion date may trigger liquidated damages, financial penalties that accumulate every single day until the project is delivered. Regulatory risk is constantly evolving. Environmental regulations, building codes, worker safety requirements, carbon reduction standards, local zoning restrictions. Each new regulation introduces additional compliance costs that must be absorbed or passed on to clients. Cybersecurity has become another modern threat. Today's construction companies rely on cloud-based scheduling software, digital blueprints, GPS-guided machinery, procurement systems, and financial management platforms. A ransomware attack can stop operations just as effectively as a broken crane. Perhaps the greatest risk of all is reputation. Construction is remarkably relationship-driven. One failed project, one high-profile lawsuit, one catastrophic safety incident, or one building delivered years behind schedule can permanently damage a company's ability to win future contracts. In construction, trust is often worth more than equipment. Despite the risks, some of the world's wealthiest investors continue acquiring construction companies. Why? Because they understand that the business isn't just about building structures. It's about controlling infrastructure, cash flow, and long-term economic activity. The first advantage is depreciation. Construction firms own enormous portfolios of heavy machinery, vehicles, buildings, and specialized equipment. These assets depreciate over time, creating significant non-cash expenses that can reduce taxable income while the equipment continues generating revenue. The second advantage is recurring demand. Cities continue expanding. Roads require maintenance. Bridges eventually need replacement. Factories are modernized. Hospitals expand. Data centers multiply. Population growth ensures that construction demand never completely disappears. The third advantage is vertical integration. Many billionaire-owned firms don't simply build projects. They also own quarries that supply stone, concrete plants, steel fabrication facilities, equipment rental businesses, engineering firms, property development companies, facility management divisions. By controlling multiple stages of the construction process, they capture profit at every link in the value chain rather than relying solely on construction margins. Another powerful asset is backlog. Publicly traded construction companies are frequently valued not only on current earnings, but also on their future contracted work. A contractor with a $10 billion backlog has years of revenue already secured. For investors, this creates greater visibility into future cash flow than many other industries can provide. Construction businesses can also become attractive acquisition targets. Private equity firms often purchase well-managed regional contractors, improve operational efficiency, centralize procurement, modernize technology, and expand into neighboring markets before selling the larger organization at a significantly higher EBITDA multiple. Then there is real estate appreciation. Many contractors accumulate valuable industrial land, equipment yards, warehouses, and logistics facilities over decades. In rapidly growing cities, these properties may appreciate dramatically, sometimes becoming more valuable than the operating business itself. Large contractors also benefit from economies of scale. Buying steel, concrete, fuel, insurance, and heavy equipment in bulk lowers unit costs, allowing larger firms to outbid smaller competitors while maintaining healthy margins. Perhaps the greatest strategic advantage is relationships. Long-standing partnerships with governments, developers, architects, engineers, banks, and institutional investors create a steady pipeline of projects that newcomers struggle to access. Over time, the business transforms from chasing work to selecting which opportunities to pursue. That shift, from uncertainty to predictable deal flow, is where real wealth is created. For billionaire investors, a construction company isn't merely a contractor. It's an infrastructure platform capable of generating cash flow, appreciating assets, tax